Welcome to RBC's Markets in Motion podcast, recorded June 10th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The three big things you need to know. First, consensus expectations for 2026 are inching up for the S&P 500 in a broad-based way. A positive data point for the stock market, but a slight one in our opinion. Second, net bulls on the AAII survey have moved up sharply and formally entered a less robust forward return environment last week. Third, the seasonal playbook reminds us that in recent years, June and July have tended to be strong for the S&P 500, but that the transition into fall has been tricky, with declines often seen in the August through October timeframe. If you'd like to hear more, here's another 5 minutes. While you're waiting, we need a favor. The Extel survey, formerly known as Institutional Investor, opened last week. If you found this podcast helpful, we'd appreciate your support in the portfolio strategy category. Last year, we were honored to rank number 3 in a tight race, our first time in the top 3. We suspect our podcast listeners did a lot to help us get there, and we'd appreciate your support again. Now let's jump into the details. We'll start with takeaway number 1. 2026 S&P 500 EPS forecasts are inching up across the board. The most interesting question we received from a client last week focused on trends in 2026 S&P 500 EPS forecasts. As we dug into the data, a couple of things stood out. First, the increase in 2026 EPS growth rate for the S&P 500 has been fairly modest in nature. The growth rate for the index next year, embedded in consensus estimates, bottomed at 13.1% on May 16th and had risen to 13.47% as of June 6th. The high for the year was 14.2% in mid-March. Second, the increase that's been seen since mid-May has been fairly broad-based. Improvement in recent weeks has been seen for the Mag 7 as well as the index X the Mag 7, with a bit more strength actually in the Mag 7 itself. And we've also seen improvement for all sectors aside from consumer discretionary staples and REITs. Third, the decline that's been seen relative to year-to-date highs is also fairly broad-based. Despite recent improvements, the expected growth rates embedded in consensus remain below year-to-date highs for the broader index, the Mag 7, and the index X the Mag 7, as well as all sectors. The sectors closest to their year-to-date highs are technology and financials. While we see all of this as a positive data point for the broader U.S. equity market for now, we do see it as a slight one that will also go through an important stress test in the next reporting season when 2Q results come in. For now, this data is sending us the same signal as our earnings revision indicators, which have been on the mend for the S&P 500, including the top 10 market cap names and the index excluding the top 10 market cap names, but these stats aren't off to the races either. We'll move on to takeaway number 2. Investor sentiment in the AAII survey formally entered a less favorable range for stock market future performance last week. When we adjusted our target a week ago, we observed that the main gauge of investor sentiment that we use in our price target modeling, AAII net bulls, was on the cusp of moving into a less favorable range for forward-looking stock market performance. As of a more recent update, this past Thursday, this indicator is now no longer officially more than one standard deviation below the long-term average, and it's back in a range that tends to be followed gains of 5% on a 7-month forward return basis. By contrast, when this indicator is in the -2 to -1 standard deviation range, where it was before, forward returns on this time frame average more than 7%. And when this indicator is more than 2 standard deviations below the long-term average, as was the case from early March to mid-May, 7-month forward returns tend to average more than 10%. This is all just another way of saying that while this indicator has not yet turned negative, the sentiment setup for the stock market is just far less favorable than it was a few weeks ago. Looking beyond AAII, there are some signs that nervousness is creeping back into some of the other sentiment indicators we track. Correlations within the S&P 500 fell sharply after hitting COVID highs earlier this year, but are starting to inch up again. The recovery in Trump's net approval and net favorability, which have been fairly aligned with S&P 500 performance, also appear to have stalled a bit. And the widely watched ISM manufacturing and services surveys also came in below expectations last week and failed to inflect or stabilize, as we'd seen in the widely watched consumer sentiment surveys from Conference Board and University of Michigan a few weeks ago. We'll wrap up quickly with takeaway number 3, seasonality. We've been starting to pay a little more attention of late to seasonal patterns. In recent years, the S&P 500 has been strong in June and July, with a tendency to experience weakness in the August through October timeframe. This keeps us mindful that even if stocks continue to climb in the near term, the transition into the latter part of the year has often been tricky. That's all for now. Don't forget to vote. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.